You know, usually when we talk about a medical diagnosis, there's this expectation of like absolute clinical precision.
Right, yeah, like engineering.
Exactly, like engineering. I mean, you break your arm, right? You go in, the x-ray shows that jagged white line on the radius bone, and the doctor just points at it and says, there it is.
Yeah.
That's the problem.
Yeah, it's totally binary. The fracture is visible. The treatment plan is obvious. And, you know, the timeline for healing is relatively predictable.
Right. But then, and this is what's crazy, you step into the world of global healthcare supply chains and corporate restructuring and international finance. And suddenly that x-ray machine is just completely busted.
Just static.
Yeah, exactly. Just static. We're looking at a diagnostic landscape that is entirely murky, especially when you're trying to figure out if, you know, a massive multinational healthcare stock is actually healing from past trauma, or if management is just sort of masking the symptoms with fancy accounting treatments.
Which happens a lot, as we know.
Oh, all the time. So today on this Talk Tickers edition of The Deep Dive, we're looking at Grifols SA. Ticker symbol is GRFS, and we're digging into their Q2 2026 earnings call.
And this is a really fascinating company.
It is. For those of you listening, this is a company that literally keeps people alive by fractionating vital proteins out of human blood plasma. But, you know, they've been carrying this absolute mountain of legacy debt and navigating these massive, massive supply chain pivots.
Yeah, the debt has been a huge story for them.
Right. So our mission today for you, the retail investor, is we need to figure out if this is a legitimate turnaround or just a value trap hiding behind corporate speak. So, okay, let's unpack this. I'm going to start with the absolute core of the business, just the raw numbers. The top line revenue for the first half of 2026 hit 3.574 billion euros.
Which, you know, is a really solid baseline. I mean, management highlighted that this represents 2.6% growth at constant currency. And with the Biopharma division, which is basically their absolute workhorse, that grew at 5.4%.
Yeah, and I actually want to pause on that for a second. That constant currency metric.
Oh, yeah, that's crucial here.
Because Grifols is in a highly specific macroeconomic position right now. Like, as a European company reporting in euros, but sourcing heavily in the U.S. and then selling aggressively into emerging markets like China, they are incredibly exposed to foreign exchange volatility.
They're getting hit from all sides on currencies.
Right. So when they boast about that 5.4% biopharma growth at constant currency, what they're essentially trying to do is strip away all that noise, you know, the strong U.S. dollar, the fluctuating RMB, just to show us that the actual unit volume and the end market demand are expanding.
Yeah, it's a totally necessary adjustment if you really want to understand the operational momentum. Because, I mean, if you just look at the raw reported euros, the picture looks artificially depressed.
Right.
The underlying reality is that doctors are actually prescribing more of their therapies. You know, patients are receiving more infusions. But as we always say, revenue only tells us if the engine is running. It doesn't tell us how much fuel it's burning to get there.
Which brings me directly to their profitability metrics. So adjusted EBITDA for the first half was 854 million euros, which, you know, puts them at a 23.9% margin. And Q2 standalone was actually even better. It hit 472 million euros at a 25.2% margin.
Which is huge.
It is. I mean, think about it. For a capital light software company, a 25% EBITDA margin might be a total disaster.
Right. They'd be panicking.
Yeah, panic mode. But I'm looking at Grifols, right? A business that requires hundreds of physical, heavily regulated donor centers, these massive cold chain logistics networks, and multi-billion-dollar fractionation facilities.
Yeah.
Maintaining mid-20s EBITDA margins in a physical supply chain like that shows some serious pricing power.
It really does. But, you know, it also reflects the massive barrier to entry in the plasma industry. I mean, you can't just spin up a cloud server and start competing with Grifols.
No, not at all.
Fractionation is this highly complex biological manufacturing process. But, you know, you're right to focus on the margins because the real story of this quarter isn't just the EBITDA itself.
Right.
It's how that EBITDA is finally translating into actual unencumbered cash.
Yes, which is the metric I always zero in on, free cash flow.
The ultimate metric.
Exactly. So CFO Rahul Srinivasan reported that free cash flow before M&A was 91 million euros for the first half. Now, I know what you're thinking. 91 million euros on a 3.5 billion revenue base doesn't exactly sound like a massive windfall.
It sounds a bit thin on the surface.
Right. But we have to look at the trajectory here. That represents a 103 million euro year-over-year improvement. Because last year, They were literally burning cash.
Yeah, bleeding that.
So getting back into positive free cash flow territory is the ultimate truth teller here. For a highly levered company, free cash flow is it's the oxygen. Like without it, you're drowning.
It fundamentally changes the conversation in the boardroom too. I mean, when you are bleeding cash, every single strategic decision is defensive.
You're just trying to keep the lights on.
Exactly. You are just trying to survive to the next quarter. But when you cross that threshold into positive free cash flow, you regain your agency. You can actually choose whether to invest in R&D or, upgrade your facilities or, crucially, in Grifols' case, actually pay down that debt.
And we absolutely cannot go any further without tackling the elephant in the room here.
The debt load.
The famous Grifols debt.
Right. It has been the single biggest bear thesis on this stock for years. So, total net leverage sits at 4.2 times. Net secured leverage is at 2.7 times. And when he was challenged on this during the Q&A, Srinivasan used a phrase that immediately made my Wall Street spin detectors just flash red.
Oh, I know exactly which quote you're about to read.
Yeah, he blamed the leverage ratios on, and I'm quoting here, notional releveraging due to euro/dollar exchange rate mismatches.
Right.
I'm sorry, but when a CFO starts throwing around terms like notional releveraging, to me it just sounds like a very sophisticated way of saying, please ignore this massive liability on our balance sheet. I mean, I completely understand the skepticism. And frankly, as an investor, you should always be wary of accounting jargon that's being used to explain away debt.
Always.
But let's actually evaluate the mechanics of his argument before we just dismiss it entirely. So, Grifols carries a significant portion of its debt in U.S. dollars. And the reason for that is they needed dollars to build out their massive U.S. collection network.
Okay, that makes sense.
But they consolidate their balance sheet in euros at the parent level. So if the euro weakens against the dollar right at the end of the quarter, the euro-denominated value of that dollar debt artificially inflates. Yeah, and that pushes the reported leverage ratio up, even if the actual cash flow generating power of the business remains exactly the same.
Okay, so you're arguing it's a legitimate snapshot distortion, like an optical illusion almost.
Right.
But a 4.2x multiple is still dangerously close to covenant violation territory for a lot of industrial companies. I mean, I need to see action, right? Not just hear explanations about currency mismatches.
And that is perfectly fair. And what's fascinating here is we actually can look at their capital allocation because their actions speak way louder than the CFO's rhetoric in this case.
Okay, lay it out.
If they were truly on the brink of a liquidity crisis, like some bears have claimed, they would be hoarding every single cent of that 2 billion euros in total liquidity they reported.
Right, you'd lock it in a vault.
Exactly. Instead, what did they do? They took $500 million and proactively redeemed their 2030 bonds.
Which, if I remember correctly, were carrying a 7.5% coupon.
Yep. 7.5%.
That's an incredibly expensive piece of paper to have hanging around your neck.
Precisely. They eliminated $500 million of high-yield debt early. And by doing that, they kept their overall cash interest costs flat for the year, which essentially neutralized the impact of other refinancing activities they had to undertake in a higher interest rate environment.
Oh, okay.
Yeah, that isn't the behavior of a distressed management team scrambling for survival. That is proactive balance sheet optimization. They are effectively utilizing their newly positive free cash flow to immediately target their most expensive liabilities.
Okay, I'll concede that. Redeeming the 7.5% bonds is a definitively bullish signal. It shows they have the cash and, they are deploying it rationally.
Yeah.
Plus, having 2 billion euros in liquidity does effectively take any near-term bankruptcy risk completely off the table.
It buys them the runway.
Right, they bought themselves the runway they need. But, financial engineering only buys you time. It doesn't actually grow the business.
True.
We need to dig into the operational engine. So let's look at the Biopharma division, specifically the immunoglobulins or IG portfolio, which grew 12.8%. And the absolute standout here was Xembify, which is their subcutaneous IG. It absolutely exploded with nearly 34% growth in Q2.
Honestly, that 34% growth figure for Xembify is arguably the most important operational metric in the entire earnings call.
Really?
Yeah.
The most important.
I think so. To understand why, you have to look at the evolution of IG therapies. Historically, if you had a primary immunodeficiency, you went to a clinic or a hospital, a nurse hooked you up to an IV, and you sat there for hours receiving intravenous IG or IVE.
Which is a huge burden.
It is. It's highly effective, medically speaking, but it severely impacts your quality of life. Subcutaneous IG or SCI changes the entire paradigm.
Because the patient can self-administer it at home, right? They're
Yeah.
basically injecting it into the fatty tissue just under the skin.
Exactly. But it's not just about the convenience of avoiding the clinic, although, let's be real, that is massive for the patient. There is a distinct pharmacokinetic advantage to subcutaneous administration.
Okay, break that down for us.
Sure. When you get an IV infusion, you get this massive spike of the drug in your bloodstream all at once, which then slowly tapers off over the next 3 or 4 weeks until your next infusion. That creates what doctors call a peak and trough effect. Patients often report feeling absolutely fantastic right after the infusion, but then they feel lethargic and vulnerable in the days just before their next dose as the levels bottom out in the trough.
So you're basically riding a biological roller coaster every single month.
Right. It's exhausting. But with Xembify, because it's administered more frequently in smaller doses under the skin, it absorbs much more slowly and steadily. It maintains a much more consistent, plateaued level of immunoglobulins in the bloodstream.
So you eliminate the trough entirely.
You eliminate the trough. The patient feels consistently better throughout the month. The side effect profile regarding things like headaches is often much improved. And as a result, the compliance rates skyrocket.
Yeah, it makes total sense.
So when Roland Wandler, the president of Biopharma, when he notes that underlying in-market demand for Xembify remains firmly in the double digits, he isn't describing a marketing win. He is describing a structural, permanent shift in the standard of care.
That is fascinating. But, the IG market isn't just treating primary immunodeficiencies. It's heavily reliant on treating complex autoimmune conditions as well.
Huge market for that.
Right. And during the Q&A, Charles from Barclays brought up a major threat to this revenue stream. He pointed specifically to CIDP, which is chronic inflammatory demyelinating polyneuropathy. And he asked if the new class of competing drugs, the FcRn inhibitors, were starting to cannibalize Grifols' market share.
Oh, this is the single biggest competitive overhang on the stock right now.
Yeah.
I mean, the market has been terrified that these new FcRn inhibitors are going to basically render traditional plasma-derived IG obsolete.
Yeah, and Wandler defended their turf aggressively on the call, arguing that doctors still prefer Grifols therapies. But let's actually break down the biology here for a second. Why would a neurologist look at a shiny new, highly targeted biologic drug and say, no thanks, I'll stick to the old school plasma proteins?
It really comes down to the fundamental nature of the disease itself. FcRn inhibitors are incredibly elegant therapeutics. They target a very specific receptor, the neonatal Fc receptor, to accelerate the degradation of pathogenic antibodies.
Okay.
If you are dealing with a disease that's driven by a single specific rogue autoantibody like myasthenia gravis, for instance, an FcRn inhibitor acts like a sniper rifle. It takes out the specific target beautifully.
But CIDP isn't a single target, is it?
Not at all. CIDP is a mess. It is a highly complex, heterogeneous, multifactorial neurological disorder.
Wow, okay.
The immune system is attacking the myelin sheath of the peripheral nerves, right? But it's doing it through multiple pathways involving different types of T cells, B cells, and macrophages. A sniper rifle isn't effective if you are being attacked by a swarm.
That's a great way to put it. So traditional IG therapy, because it contains the pooled antibodies of, tens of thousands of different healthy donors?
Yes, exactly.
It has what neurologists call a pleiotropic, or broad mechanism of action. So it's more like a shotgun approach. Or maybe a broad-spectrum antibiotic is a better analogy.
I like the broad-spectrum analogy. It modulates the immune system across multiple fronts simultaneously. And Wandler really emphasized this point because it's exactly what they are hearing from the actual prescribers in the field.
The doctor's actually treating the patients.
Right. Neurologists know that IG works for CIDP. They have decades of clinical data backing it up. And the disease is so debilitating, leading to progressive weakness and eventually paralysis, that if a doctor has a patient stabilized on Grifols IG, they are extremely reluctant to take them off a proven broad-spectrum therapy.
Because they'd risk a severe relapse just to try a new, narrowly targeted drug.
Exactly. The switching costs from purely medical risk perspective are just way too high. That is why Grifols continues to defend and even grow its share in the CIDP market, despite all these new entrants.
That makes perfect sense. I mean, the clinical inertia is actually a massive protective moat for their cash flows, but we can't ignore the areas where the moat is shrinking. Let's pivot to the albumin market in China, because this was cited as a major drag on the quarter.
Yeah, this was a tough spot.
Sales faced a really tough comparison, and management explicitly blamed mid-2025 price adjustments in China. So what are the actual dynamics of that Chinese market right now?
China is a very unique beast when it comes to pharmaceuticals. It is arguably the most important growth market for albumin globally, and that's driven by heavy use in treating things like liver cirrhosis and massive trauma.
Okay.
However, the Chinese healthcare system operates on a centralized procurement model, often referred to as VBP or volume-based procurement.
Right. This is where the government essentially comes in and says, we will guarantee you this massive volume of sales across all our provincial hospital networks, but you have to drastically slash your unit price to win the tender.
Exactly. It's a race to the bottom on price in exchange for monopoly on volume. So in mid-2025, a new round of these pricing adjustments went into effect, which squeezed the margins on albumin significantly.
Ouch.
Yeah. So when Grifols reports their H1 2026 numbers, they are comparing a period of lower VBP-adjusted prices against H1 2025 when they were still enjoying the older, higher pricing.
Which mathematically guarantees a negative year-over-year comparison.
Right. It looks bad on paper.
Yeah, and Joaquin from GB Capital pressed them on this during the call, essentially asking if this was just a bottomless pit of price cuts. But Wandeler's response was very carefully calibrated. He claimed they're actually seeing stabilization in both the mandated price levels and the end-user prescription volumes.
And he also pointed out that the comparisons get much, much easier in the second half of the year.
Because in Q3 and Q4 of 2026, they will be comparing against Q3 and Q4 of 2025 when the price cuts were already fully implemented, right?
Exactly. The massive year-over-year headwind magically turns neutral. But I think more importantly, the underlying volume demand in China for albumin remains absolutely voracious. Once that pricing floor is firmly established, Grifols can get back to growing total revenue based purely on increased volume output.
And speaking of volume output, we need to dive into what is easily the most fascinating operational pivot this company is making. And that is the total restructuring of their global supply chain.
This is massive.
To me, this is where the long-term thesis for Grifols is really being written. They announced the closure of 29 U.S. donor centers, which, by the way, incurred a massive $40 million one-off restructuring hit.
Which dragged their reported gross margin down to 37.6%.
Right. But simultaneously, they are aggressively accelerating their plasma collection in Egypt, to the point where Egypt now accounts for 25% of all their ex-U.S. plasma collections.
And to understand how radical this shift is, you have to understand the historical structure of the plasma industry. Because for decades, the United States has essentially been the OPEC of blood plasma.
The OPEC of plasma, I love that.
Because the U.S. allows for the commercial compensation of plasma donors, whereas most of Europe and other regions rely on uncompensated altruistic donation, the U.S. has been the only country capable of generating the sheer volume of plasma required to supply the global fractionation industry.
Right. So companies like Grifols would just blanket the U.S. with collection centers, harvest all the raw material, process it, and then ship the finished therapies all over the world.
But the economics of that model have severely, severely deteriorated over the last few years.
How so?
Well, the labor costs to staff those U.S. centers have skyrocketed. The real estate leases are way more expensive. And crucially, the donor compensation fees, the money required to incentivize people to actually walk through the door, those have inflated significantly.
So the cost of goods sold, the literal raw plasma itself, has become exorbitantly expensive when it's sourced in America.
Exactly. And this creates a massive margin squeeze. I mean, think about it. If you are collecting plasma at hyperinflated U.S. prices and then fractionating it into albumin that you have to turn around and sell into China at government-mandated slashed VBP prices,
My math just blows up.
The math simply stops working. Your margins evaporate.
This is where I want to push back a little, though, or at least play devil's advocate for a second. I look at this $40 million charge to close 29 U.S. centers, and management pitches it as this great efficiency drive. But shutting down physical infrastructure is painful.
It is.
Now, excluding those one-off costs, their adjusted gross margin does jump back up to a very healthy 39.4%. But moving 25% of your ex-U.S. supply to Egypt, that feels fraught with geopolitical and currency risk. I mean, the Egyptian pound has been incredibly volatile. Are they just trading U.S. wage inflation for emerging market instability?
It's a very sharp question, and the risk you are pointing out is absolutely real. However, if we connect this to the bigger picture, the strategic brilliance of the Egypt move, and why they are actually targeting Egypt to represent 50% of their ex-U.S. supply by 2029, it goes far beyond just finding cheaper hourly labor.
Okay, explain that.
It's about perfectly matching the biological output of the plasma with geographic demand.
Okay, Break that mechanism down for us, because this gets into the weeds of how fractionation actually works.
Right. When Grifols takes a liter of human plasma and puts it through the fractionation process, they don't just choose to make one drug.
Right. It's not a vending machine.
Exactly. The process yields a basket of different proteins simultaneously. You get Ig, you get albumin, you get alpha-1, and you get various clotting factors. You have to sell all of them to make the economics of that single liter of plasma work.
You can't just tell the machine, hey, we only need Ig today. You get the whole barrel.
Precisely.
Yeah.
Now, as we established earlier, China and the broader Middle East and North Africa regions have a disproportionately massive clinical demand for albumin.
Okay.
But they have a relatively lower demand for Ig therapies compared to Western markets.
Ah, okay. I'm seeing the puzzle pieces come together here.
By building out this massive collection and fractionation infrastructure in Egypt, Grifols is sourcing the plasma at a fraction of the U.S. cost. They fractionate it locally, they take the albumin yielded from that process and sell it directly into the Egyptian and broader regional markets.
Wow.
Perfectly satisfying that high local demand at a highly profitable margin because the input costs were so low.
And what happens to all the Ig they extracted from that Egyptian plasma? Because the local demand is lower, right?
They export it directly to Europe. Europe has massive Ig demand, so instead of supplying Europe with Ig derived from ultra-expensive U.S. plasma, they are supplying it with Ig derived from highly cost-effective Egyptian plasma. This is an absolute masterclass in global margin expansion.
That completely flips the script on the U.S. closures. So, closing those 29 U.S. centers wasn't a retreat. It was a highly targeted pruning operation, like pruning an overgrown garden.
Yes, exactly.
They don't need that expensive U.S. plasma to supply the rest of the world anymore. Egypt is the new greenhouse. They are keeping their U.S. collection footprint perfectly sized to supply only the U.S. market, where they can command the premium U.S. healthcare prices necessary to justify the high U.S. collection costs.
You nailed it.
They are matching local cost of goods sold with local pricing power across two completely different hemispheres simultaneously.
That is the exact thesis. And it proves that Grifols is no longer a U.S.-dependent company masquerading as a global entity. They are actively building a truly bifurcated, self-sufficient global supply chain.
Okay, before we move into the future guidance, let's briefly touch on the diagnostics division because it's not their primary engine. But they made a significant structural move here by dissolving their joint venture with QuidelOrtho.
Yeah, that was interesting.
And they also successfully launched a new blood typing platform called Evansys IH. Jamie from Santander asked about this, noting the JV dissolution caused a temporary year-over-year revenue dip for the segment. Is this a distraction, or is management clearing the deck for something bigger?
It's absolutely a deck-clearing exercise. The diagnostics division, which provides testing equipment for blood banks and hospitals, has always been a very steady, cash-generative pillar for Grifols. The QuidelOrtho joint venture was lucrative, sure, but it came with severe non-compete restrictions.
Right, which ties their hands.
Exactly. By breaking that JV, they take a short-term revenue hit, but as CEO Nacho Abia pointed out on the call, they regain complete strategic freedom.
Freedom to do what? Exactly.
Freedom to aggressively attack the $1 billion immunoassay market with their own proprietary, wholly owned technology. They are developing a next-generation platform called ISARD, which is slated for around 2030.
Okay.
If they had stayed in the JV, they would have been restricted in how they could deploy ISARD. By ripping the Band-Aid off now, they own 100% of the upside later.
Makes sense.
In the meantime, the successful launch of the Evansys IH platform, which is a smaller, highly modular blood typing system that dramatically simplifies lab workflows, it shows they aren't just waiting around for 2030. They are executing on the immediate pipeline while preserving their long-term strategic optionality.
It fits perfectly with the overarching theme of the quarter, right? Accepting short-term structural pain, whether it's U.S. center closures or dissolving JVs, to drastically improve the long-term margin profile.
Exactly.
So the pruning is done. The garden looks leaner. Let's look at what management is promising for the harvest. I want to transition into their forward-looking guidance, because this is where the stock is actually going to be priced over the next 12 to 18 months.
Guidance is where the management team's credibility is truly tested, and they maintain their full-year free cash flow target of $500 million to $575 million.
Which implies a very steep ramp in the second half of the year, given they only generated 91 million euros in the first half.
Yeah, they are heavily backweighting their expectations. They noted they expect mid to high single-digit growth for IG in the U.S. and Europe to help drive that cash flow.
But honestly, the financial targets aren't what caught my attention in the guidance section.
No.
It was a clinical milestone. They spent a significant amount of time discussing the SPARTA phase 3 study for their alpha-1 deficiency therapy.
Oh, yes. This is huge.
They noted the absolute last patient visit occurs in August, which sets up a massive top-line data readout for Q4 2026. So let's break this down for the investor who doesn't hold a medical degree. What exactly is alpha-1, and why is this SPARTA trial such a monumental catalyst?
Okay, so alpha-1 antitrypsin deficiency is a genetic disorder. To put it simply, your liver produces a protein called alpha-1. Its primary job is to travel to your lungs and protect the lung tissue from being destroyed by your own immune system.
Wait, your own immune system attacks your lungs?
Specifically, an enzyme called neutrophil elastase. If you have this genetic deficiency, your liver doesn't produce enough of the protein, or it produces a mutated version that gets stuck in the liver.
So your lungs are left completely defenseless.
Exactly. The neutrophil elastase basically runs rampant, breaking down the elastin in the lungs. And this leads to severe early onset emphysema and COPD, even in patients who have never smoked a day in their lives.
That is awful.
It is. Now, Grifols is already the undisputed global leader in treating this with what they call augmentation therapy, where they literally infuse the patient with purified alpha-1 protein derived from plasma to replace what their body is missing.
Okay, but if they are already the market leader, why is a new phase 3 trial such a big deal? Like, what more do they have to prove?
It's all about expanding the total addressable market. Right now, Wandler estimates that a staggering 85% of eligible alpha-1 patients are currently undiagnosed or untreated.
85%, that's massive.
The bottleneck is convincing primary care doctors and pulmonologists to routinely test for the genetic defect, and simultaneously convincing massive insurance payers to cover the expensive lifelong augmentation therapy.
Insurance, right. And payers don't want to cover it unless you can prove beyond a shadow of a doubt that the incredibly expensive plasma therapy actually halts the progression of the disease rather than just, masking the symptoms.
Exactly. And proving that is remarkably difficult. I mean, you can't just give a patient the drug for a month and ask how they feel. Lung tissue degrades slowly over years.
Right.
The SPARTA trial is a 3-year outcome study. It is the most comprehensive, logistically grueling clinical trial ever conducted in the alpha-1 space. It is the first phase 3 trial specifically designed to assess the actual preservation of lung density using high-resolution CT scans over a prolonged period.
So they are trying to prove, visually and mathematically with CT scans, that patients on their therapy literally retain more lung tissue over 3 years than patients who aren't.
Yes. And Charlie from Bank of America drilled into this during the Q&A, specifically asking about the 2 different dose levels they are testing. They're testing a standard 60 milligram dose versus a massive 120 milligram dose. Grifols is basically betting that the higher dose will show a statistically undeniable preservation of lung density.
If that data comes back positive in Q4 2026, that is an absolute game changer. It provides irrefutable clinical evidence. It forces the medical guidelines to change. It forces payers to capitulate.
Suddenly, that 85% untapped, undiagnosed market becomes fully accessible.
And Grifols, sitting on the largest alpha-1 fractionation capacity in the world, captures the vast majority of that multi-billion-dollar expansion.
It is a massive binary event. A positive readout fundamentally alters the growth trajectory of their entire respiratory franchise.
So for anyone holding the stock, late Q4 is a giant red circle on the calendar. But, and here's where it gets really interesting, as massive as the SPARTA trial is, management casually dropped a structural bombshell during this call that could dwarf it in terms of immediate shareholder value creation.
Yeah, this was the moment of the call.
They announced they are formally splitting the Biopharma division into 2 distinct operational units, U.S. and rest of world, and they're evaluating a potential IPO of the U.S. Biopharma business.
This is pure, unadulterated financial engineering designed to shatter the conglomerate discount currently dragging down the stock price.
Let's walk through the mechanics of this, because spinning out a crown jewel asset is a massive, complex undertaking. Why would a Spanish parent company want to IPO its most profitable, vertically integrated division?
You have to look at how Wall Street currently values Grifols as a whole. Right now, when an analyst builds a financial model for GRFS, they are looking at a messy, highly complex global conglomerate.
Right.
They see the incredible cash generation of the U.S. IG market, sure, but they mix that in with the severe pricing pressures in China. They mix it in with the geopolitical risk of shifting supply chains to Egypt.
It all gets blended together.
And most importantly, they heavily discount the entire valuation because of that 4.2 times debt leverage sitting on the parent company's balance sheet.
So the market is looking at this murky X-ray we talked about at the beginning of the show, getting spooked by the shadows and assigning a lower price to earnings multiple to the whole company than the individual parts actually deserve.
That is the textbook definition of a conglomerate discount.
Yeah.
By formally separating the U.S. business, which, remember, is a mature, fully vertically integrated beast with 280 donor centers and 2 massive manufacturing sites management, is creating a clean, pure play U.S. plasma asset.
Right.
If they IPO a minority stake in that U.S. business on an American exchange, the market will assign it a much higher premium valuation multiple, completely unencumbered by the China risks or the rest of world restructuring costs.
And what does that mean for the retail investor who owns shares of the parent company, GRFS, today?
It is a massive value unlock mechanism. First, the parent company receives a gigantic influx of cash from selling that minority stake in the IPO.
And what do they do with that cash?
They immediately deploy it to wipe out a massive chunk of that legacy debt. Suddenly, the parent company is deleveraged.
Wow. And you, as the shareholder of the parent company, still own a business that holds the majority controlling stake in the newly public, highly valued U.S. entity. Plus, you own 100% of the rapidly growing, high-margin Egypt/rest of world platform.
Exactly. It forces the market to conduct a sum of the parts valuation. It's an aggressive, highly confident move by CEO Nacho Abia and the board.
It's a power move.
It really is. They are essentially staring down the institutional short sellers and saying, if you refuse to value our U.S. operations fairly while they are hidden inside our global structure, we will put them on the open market and let the free market bid the price up to where it belongs.
It is brilliant, but it is also fraught with execution risk, isn't it? I mean, carving out the legal entities, managing the transfer pricing between the U.S. and Spanish entities, and navigating the SEC regulatory hurdles for an IPO of this scale, that will take massive bandwidth from the executive team. This isn't going to happen next quarter.
Oh, no. It is absolutely a 12 to 18-month process minimum. But the mere announcement that they are actively evaluating it puts a floor under the stock. It provides a clear, credible pathway to deleveraging that doesn't rely solely on just grinding out incremental operating cash flow over the next decade.
Okay, so we've dissected the financials, we've walked through the strategic pruning of the U.S. centers and the massive build-out of the Egyptian greenhouse. We understand the biological moat protecting their CIDP market share, and we've laid out the dual massive catalysts of the SPARTA trial and the potential U.S. Biopharma IPO.
We've covered a lot of ground.
We have. So what does this all mean? It is time to bring this all together and render a verdict for our listeners' portfolios. Are the results from this Q2 2026 earnings call a bullish or bearish signal?
Well, if you look at the totality of the evidence, the return to positive free cash flow, the proactive debt management, the margin expansion enabled by the Egypt strategy, and the structural optionality of the IPO, the verdict really has to be bullish on the company's operational execution. However, I would temper that with a strong note of caution regarding the timeline for the retail investor.
Right, because the structural changes they are undertaking are massive. I mean, ramping up Egypt to 50% of their ex-U.S. supply by 2029 is a multi-year capital expenditure project. Executing an IPO is a massive legal undertaking. Running a 3-year clinical trial like SPARTA requires immense patience.
Exactly. This is not a meme stock that is going to gap up 40% overnight on a surprise revenue beat. It is a massive, complex industrial ship that is slowly but very deliberately turning in the right direction.
The narrative is shifting.
The bears who were predicting an imminent liquidity crisis a year ago have been proven mathematically wrong by the 2 billion euros in liquidity and the $500 million bond redemption. The bankruptcy risk is off the table.
So synthesizing all of this for the investor who is looking at their portfolio right now, Grifols is a company that has finally recognized the severe inefficiencies of its legacy business model and is ruthlessly executing a plan to fix them. They are sacrificing top-line vanity for bottom-line sanity. They took the $40 million hit to close the inefficient U.S. centers because they knew the Egyptian supply chain would yield vastly superior margins on the European IG exports.
That's the key.
And they are defending their core medical franchises. as evidenced by the 34% growth in Xembify, proving that underlying organic demand for their therapies remains incredibly robust.
And most importantly, they are creating their own catalysts. They aren't just sitting back hoping the macroeconomic environment improves. They are pushing the SPARTA trial to completion to force an expansion of the Alpha-1 market, and they are leveraging the capital markets via the potential IPO to forcibly extract the hidden value of their U.S. operations.
So the x-ray we talked about at the beginning of the show isn't nearly as murky as it was 12 months ago. The patient had been in the ICU, but the vital signs are stabilizing, the heavy depth bleeding has been stopped, and they are moving into a very intense but promising physical therapy regimen.
That's a great way to put it.
For the retail investor, this looks like a solid hold for the restructuring payoff, provided you have the patience to wait for the Q4 SPARTA data drop and the IPO filings to actually materialize.
I think that is the most rational, data-driven synthesis of where the company stands today.
Well, before we sign off, I know you always like to pull the lens back and leave us with one final provocative thought to mull over something that perhaps wasn't explicitly modeled out by the analysts on the call, but is sort of bubbling right beneath the surface of the macro narrative. What are you looking at?
I want you to think about the broader geopolitics of global healthcare infrastructure.
Okay.
We spent a lot of time today discussing Grifols pivoting their plasma sourcing away from the U.S. and heavily into Egypt and Canada. Now, as we analyzed it, that move makes perfect sense on a spreadsheet. It expands gross margins, lowers the cost of goods sold, and perfectly aligns regional product demand. But look deeper at the macro environment we are operating in today.
You're talking about the shift away from hyperglobalization.
Exactly. We are living in a world increasingly defined by border restrictions, aggressive trade tariffs, and profound supply chain fragility.
Yeah, we've seen that play out.
We all learned the hard way a few years ago what happens when a vital medical component is single-sourced from a country that suddenly locks down its borders. Historically, the United States has been the undisputed Saudi Arabia of blood plasma. It supplied the entire world. But Grifols is implicitly placing a massive multi-billion-dollar bet that the future of healthcare requires regional resilience.
They're immunizing their own business model against the threat of deglobalization.
Exactly. Think about it. If another global crisis hits, a pandemic, a severe trade war, or massive geopolitical instability, and the U.S. restricts the export of vital biological raw materials to protect its own citizens, every other fractionation company that relies solely on U.S. plasma will be functionally paralyzed. Grifols, on the other hand, will have a fully self-sufficient, completely insulated European and rest-of-world supply chain anchored by their operations in Egypt and Canada. As an investor modeling out cash flows for the next decade, you have to ask yourself, how much of a valuation premium will the open market soon place on healthcare companies that possess absolute sovereign supply chain security?
That's huge.
Because I guarantee you, the smartest institutional money is already starting to factor that geopolitical hedge into their models.
That is a fascinating lens to view this through. It really elevates the Egypt strategy from a mere cost-cutting exercise into a massive structural moat against global instability. Well, that brings us to the end of this incredibly dense diagnostic journey. Thank you so much for riding shotgun with us on this Talk Tickers edition of our deep dive into Grifols. We hope we helped clear up those diagnostic muddy waters and gave you a framework for evaluating the real story behind the numbers. Keep asking the hard questions, keep looking past the headline metrics, and always stay curious about the complex mechanisms driving the stock tickers. We'll catch you on the next deep dive.